calm seas make for bad captains, is the saying. I was reminded today on Twitter. Same goes for sadomasochists, right? We need the pain in order to feel the pleasure. Welcome, Web3 media friends, to another show about entrepreneurs, artists, and those pursuing, in media and in Web3, our goals and dreams and generational wealth. But we're not a show about financial advice ever. Just want to state that straight up off the top. We're going to get a little into talking about the markets because it's undeniable what is going on. And I didn't sleep last night. I just was riding with you guys, just like watching as stable coins were depegging from their trading. And so it's a scary case, but that's the thing is here on the show we're very optimistic about the opportunities that these uncertainties present. And I went and brought on one of my good friends, Nilay Vora. Fulbright scholar, Harvard trained, brilliant mind in the legal biz, who has some significant experience in the banking area in terms of litigation. And I've also brought on, of course, one of my correspondents today, Max Payne. Max Payne, you here? Hello. As a veteran in this space, I've seen quite a bit. Some people say that, oh, you drank that M2 serum. No. This that you see here, this is just 2 years of crypto. I mean, it definitely is hard to sleep. And, I was up all night myself watching, the USDC depeg, and then people realizing that DAI was made up half of USDC. You can just see like a thought process, and then suddenly DAI, was dropping significantly. Oh yes, I love pegs. But don't worry, I have my cod piece on still for now. You can see down there. But, you're going to get the pain, It's a good feeling. It makes you feel alive. Well, you certainly like the pain, and as well as to receive it. It's just like, you really do love to receive it. Oh, yes. I mean, we're going to go over these exciting charts for me, but... have you any student loans that I can fill out as well? No, but we do have these amazing charts for you, and because they're live, and we do this live, so please give us a like and a share as we do this live, because we do this live because I want to talk about these things as they're happening and be cogent and sort of, have an impact so that we all know sort of and are best informed about, what our options are in these scenarios. And so... whether you're touched by the contagion or not. We see the headlines. And I think that CoinDesk did a really good job of looking at the tale of two banks. And so why Silvergate and Silicon Valley Bank collapsed, but they're different in different ways because, Silicon Valley Bank, just went into liquidation. And so they just were like, okay, great. So, if you look at the price of Bitcoin, it was like, okay, great, we got to liquidate, and bang, sold off, no FDIC, insurance needed, no bailouts, no, so basically everyone who put their money in was made whole. You put in your funds, you got it back, unless you were an investor. Now, that's the thing. It's like if you're an investor, you're in it for a different reason because you're like, okay, what are you guys going to go after? You guys are going to give loans. You guys are going to to very, very speculative individuals. You're going to give loans to, people coming out of Ivy League colleges with no source of income, but a really cool idea about the future. Amazing. That's a business model, and you invest with that. Didn't work out. But the people who put deposits in the bank were made whole with Silvergate. Not the case here for Silicon Valley Bank. And so that's part of, why it's gone into receivership. And we'll talk with Nilay more about what receivership is and what it means when you can expect, because look, this might not be the first time that this happens. It's not the first time, certainly from a central bank standpoint or a central entity standpoint. But when it's a bank, it had far-reaching implications. Rippling into Rippling. Rippling is a payroll service, a very popular one. Used to help businesses and projects meet standard, payroll across the world. So it's just like everybody's got different, rules in different states. And so helping to make them compliant, are companies like Rippling. But they also need intermediary banks. And in this case, they use SVB. And that could delay things. And, we'll go into a little more of what happened there with Nilay. But, we all were also watching this is what happens too in a hot bull market, or really, highs and lows, is you get stuck into this gas freeze. Like for me, it happens to me. I'm just like, oh, I can't even unload this asset without losing significant money in gas. I mean, Gwei was up to 380. I saw $150 gas, being snapshotted across Twitter. It's like, oh yeah, remember that bull market we were on? But it's like you're also like stuck in a position to some degree, unless it's a considerable movement that you have. But if you're the everyday investor, you're stuck. So you have to watch this thing unfold. And to even chagrin of even more standard, just regular investors like you and I, it was just like, oh, suddenly they were like, hey, yeah, Coin was like, or Circle was like, we don't want you to trade any USDC anymore. And so they put a pause on it until Monday. And so now that doesn't stop, a lot of the AMMs and the pairs that are existing from trading and speculation about it. Even to the point where I love Greg Osuri. Greg Osuri, who's over at Akashnet, CEO, one of my favorite projects. We talk about it all the time. And he's just one of these, like, really just level-headed people. And, like, he's just, like, noting that, look, even Vitalik is buying USDC. It's like, at this point, it's just like there's backing, there's financial backing. There's, the large percentage of reserves, especially Coin, which is Coinbase. And if you're a customer of Coinbase, you understand this level of regulation. The KYC, like, they're so heavily, wanting to go public that they met every government regulation, and certainly and by way of having reserves and being able to be liquid to back, a stable coin. And so, Circle now has $40.2 billion in liquid reserves, cash and short-term treasury bonds to back their current market cap. And so, it's like everyone's starting to realize, I think, and making their own, speculative plays on, a nice 10% if you're down here, geez. And so, come Monday, a plan will be gathered. Or as we kind of hypothesize in this talk, maybe a buyer, maybe somebody that can rescue, in a sense, the bank. We saw a lot of that action with FTX in a very, very different way. Again, I want to stress, there was a lot of we're watching a stable coin go down, but there's definitely a different vibe with this one, and hopefully cooler heads will prevail. But I present this chat with Nilay Vora so that your heads will indeed hopefully cool as well. Welcome, Web3 Media friends. I am super excited today to talk to a friend, Nilay Vora, who's a Harvard-trained lawyer with expertise in suing banks. And I brought him onto the show because here at Crypto Media Friends, we want to reach out to our friends when it comes to, talking points about, this is not a big show on markets, but about, entrepreneurs, artists, and those in the space, who are building. And, today it's hard to not talk about, what's going on with Silvergate and Silicon Valley Bank. And, CoinDesk reported how Silvergate's collapse really differentiated from Silicon Valley Bank's TLDR. There was no FDIC bailout. So it's just like, okay, wait, hold on. What's the story here? And so, Silvergate, liquidated assets. They're more, crypto backed. And so they liquidated their assets. We saw, and I'll show you the charts later, Bitcoin dipped and, it sort of worked itself out. And, depositors were made whole. The shareholders, investors lost their ass. But that's the thing. You're supposed to do that when you're I'm investing in this very risky thing and, it all disappears. Okay, that's on me. But the people who, made deposits, they were made whole without FDIC insurance, without a bailout. But suddenly here comes the story of Silicon Valley Bank. And Silicon Valley Bank, which is less tied to crypto, required FDIC receivership, and so I want to bring on Nilay to talk about what is receivership, and sort of the perspectives from the small entrepreneur to the employee who might be facing shortfalls and what to expect, so that we can kind of get sort of clarity and feel a bit more empowered in this scenario of complete free fall, because we'll see from the charts later that the market is overreacting, to some degree. But obviously, when we all experienced FTX together, it was a shitstorm. The storm is going to be a little lighter, we hope, this time around. But we want to make sure that beyond the marketplace action, we have an understanding as participants in Web3 of what to expect. So, Nilay, welcome to the show. Thank you so much for being here.
Thanks for having me on, Minty Fresh. I'd love to be on. It's a real honor. And looking forward to answering some of your questions.
I think that the big question is just like in receivership. It's a scary word. I experienced it myself, in this horrible scandal that was, second to Bernie Madoff. I was in this fund, and they were just like, okay, now it's, it's in receivership. And I was like, oh, cool. Am I going to get my stuff back? Like, what's going to happen? The biggest thing was it took forever. It took weeks for just the regulators to get in and assess. There was just so much time and assessment that it was freaky. Should we expect the same here in terms of like an FDIC sort of takeover?
Yeah, it's a good question. I think the thing that you should expect right now is that, according to media reports right now, and generally with respect to the FDIC, the first thing that's going to happen is that you're going to start at the insurance limit. So we'll start at the very beginning, though. So what is a receivership? A receivership is just a fancy legal word for we are going to take over your stuff. If I were allowed to use bad words, I would use one that starts with an SH. We are going to take everything. We are going to take it all. All the bad words. It's ours now.
We're all adults here, and we are. It's always hard for me. When you're losing your bags, when you're losing your money, when you're losing all your generational wealth, all those words will come to the surface. So please.
So there we go. All right, cool. So look, the FDIC is going to come in. They said this shit is now out. Okay, so. What happens is the FDIC comes in, they say, okay, this is all, we are shutting you down, no more operations, et cetera, et cetera. Sometimes they'll make exceptions for certain things in the near term. Some things they literally cannot figure out exactly how to shut down, standard stuff, which levers do I need to pull to shut this down, shut that down. So what ultimately the goal of the FDIC is, however, is to stop the bleeding when you have a bank run. As you probably are aware, a bank run occurs when a bunch of people who have assets that are deposited at the bank suddenly all try to pull it out by itself. Now, basic shadow banking is a fancy word for basic fact that when you deposit your money at the bank, you are basically asking the bank to store that money for you. But the bank doesn't really just store the money for you. The bank also engages in other things. It invests some of that money, it loans some of the money out to probably also people like you. Silicon Valley Bank, for example, was very famous for permitting founders, other executives at startup companies to, for example, take out mortgages, letting the businesses themselves that were started to take out business loans, despite the fact that they had zero revenue. So when you put your money in, you're not always just leaving it there and it's just sitting there in a safe. And so as you're aware, when that happens and then when there's a run on the bank, there are too many depositors that are trying to get all their money out. The FDIC comes in and they say, okay, everybody freeze. All this shit, this is now ours. We are going to take control of it. And they act almost like an occupation force, and they're going to come in and they're going to take over. They're going to stop everything. Probably on Monday, according to reports, the FDIC is probably going to start refunding people up to $250,000 from the FDIC insurance limit. And then following that, it's going to be a mess. Everybody who's got accounts that had any kinds of deposits, and now remember, some people, the smart thing to do sometimes in these kinds of situations, and I actually had some clients that are this sophisticated and this tedious, and it's very impractical to do it sometimes, but some clients will really try to keep their deposit accounts under $250,000 or right around as low as they can there. Now, look, for a lot of people, this just doesn't make any sense. You're buying and selling, north of $250,000 per transaction. You got to keep more money liquid in the account, so you can't do it. But what's going to end up happening is the FDIC is going to then go through the painstaking process of how do I get more money back in, and how do I ultimately get more money back out to the depositors who lost their money.
Will they, in some way, like with the auto industry, how the government found suitor? Will they actively seek buyers, perhaps, to come in and sort of make a rescue?
It's possible that they will do that. I mean, it's interesting that Silicon Valley Bank actually also itself tried to do that, in addition to kind of that big capital raise they tried to do by selling more shares on the market. But again, that just exacerbated the problem. So is it possible? Yes, it's possible. Is it guaranteed? I don't know that it is guaranteed that would happen. But the FDIC's role in this is not altogether dissimilar from what would happen in a classic kind of bankruptcy proceeding. And I know that Silicon Valley Bank is not yet in a bankruptcy proceeding, but it would not be altogether different from that, to the extent that ultimately there is a bankruptcy proceeding. That's ultimately what's probably going to end up happening. But the FDIC's role will be a little bit different for the moment, in that the FDIC is specifically designed to ensure that, with respect to banks, that banks are able to return money to their depositors, and that's their number one goal, as opposed to a bankruptcy trustee who's going to be involved in trying to make sure that creditors are able to be made whole. Secured creditors first, unsecured creditors, people who are owed wages, that kind of thing. There's priorities in bankruptcy, but the FDIC is actually more specifically focused on depositors.
Mm. And when it comes to Rippling, the payroll company, where do they lie in that sort of spectrum of priority?
It's very unusual. Rippling, as I understand it, really just used Silicon Valley Bank for purposes of processing the payments themselves. So this is a little bit of an unusual situation. A lot of people don't understand that banks aren't just these traditional institutions that kind of, you walk into. Back in the day, most people do online banking these days. But I personally don't like writing physical checks. I find it very annoying. I don't like to balance my bank account. It's very annoying. I do balance it, don't worry. But I find it like a foolish exercise, in the sense that, why isn't it the case? So what I found with my bank is that I bank at Citibank, and so I can do online checks, and it's just much easier because they immediately, as soon as the check is issued, they immediately take that money out of my account. And then what they do is they basically put that money into, this is not actually what happens, but this is the basics of it. They'll basically stick a dollar amount into what's effectively an escrow account. It's not actually an escrow account. I'm just using that as a loose term here just to explain to the audience. So it's in this middle escrow account before, ultimately, when it gets deposited, it goes to the payor, the payee, the person that I'm paying. It will go into their bank account. Now, in real life, this all happens through automated clearinghouse, the Federal Reserve Bank, et cetera. And so there will be a middle person. And so what Rippling was doing was using Silicon Valley Bank as the payment processor. What happened with Rippling, though, is actually kind of even more unusual in terms of determining how far this could really spread. But in some ways, it also shows how limited it could be to spread. Rippling only used Silicon Valley Bank for the purpose of processing the payment. So, for example, not every single Rippling customer had all of their operating account money for their company in Silicon Valley Bank. But Rippling would use Silicon Valley Bank to take the money out of, let's say, Chase Bank. So they would take it out of Chase. They would put it in, Rippling would take it out of there. They would use Silicon Valley Bank then as the intermediary, and then it would go to the payee's bank account, Wells Fargo, whatever. So in this sense, what happens...
You got a lot of chunks there, and so that big chunk that goes, out of, the payroll, essentially, the payroll, fund, then goes into Silicon Valley Bank and then gets shipped off into the individual accounts. And
so what you're saying is exact. So that's right. I'm glad. Thank you for that clarification, because what happens then is that it's that middle chunk here. All they're doing is processing the payment. That's all they're doing. They're not actually kind of holding the money. But the problem is, when the FDIC came in and said, hang on, this shit is ours now, they're going to stop all of those kinds of processing and transactions, even if you're just the middle person.
Yeah, and I think that it's interesting. Like, there's 2 points there. First, I want to ask you, sort of, and I'll come back to it. Are those funds essentially frozen? But B, what I want to clarify for Rippling, what they did was they were kind of saying, like, look, we know we're in a situation, we are going to pay out of our own capital to run payroll that's due for this week, ostensibly. And then we're going to figure out, a bridge with their future partner, JP Morgan Chase, as to, how to continue. And but in that interim, as you're saying, are these assets frozen? Like, nobody can play with them until the FDIC says, okay, we're going to now prioritize these people and sort of get them paid first.
Yeah, theoretically, that's exactly what's happening, is that the assets are frozen, and that's why Rippling had to do exactly what you talked about. And in fact, it's kind of ironic that Rippling had to do that, because back in the day, Teddy Roosevelt used to have to ask John Piermont Morgan, to go ahead and bail out certain banks and whatever else, because the Federal Reserve banking system was not yet the robust system that it is now. So it's kind of ironic that you're seeing micro versions of that happening, with Rippling going to JP Morgan and asking for kind of, we'll cover this through our own capital, and then we'll sort it out on the backside.
Hey, if you got Lucci like that, might as well be a mensch, help people out, because it's a crap situation, and that's the thing, is like, is there sort of a, given what you know about the SVB and sort of the ways that FDIC executes, like, how long could this drag out in terms of just looking at those assets and then finding ways to divvy them out?
This could go for a really, really long time. I mean, look, the closest thing that I've seen to this is something like the 2007 to 2012-ish time frame, with the big housing bubble burst and all the mortgages and the mortgage-backed securities. People don't realize that even right now, the FDIC is still able to sue over those assets related to those mortgage-backed securities from those time frames. They had federal laws that were passed as a result of congressional action that extended the amount of time that they had to sue to try to recover some of those things. But basically, the way that this works is the FDIC is basically an insurance company, and so when they ultimately end up paying things out, they're not paying it out of the goodness of their hearts. You're paying into a system, the banks are paying into a system, and it exists, but in exchange for paying into that system and then paying out those insurance for that first $250,000, the FDIC gets to control the claims then that can be made against other people. And so, like I said, right now, even from the 2008 timeframe, there are still lawsuits that are still being brought because of FRA and other federal laws that, sometimes I forget the acronyms, even myself, what they stand for. But it's possible for this to last for a very long time.
So we have two people that, sort of I care about, and it's part of my audience here, and that's, sort of the programmers, the builders, the people who are going to be receiving these paychecks and these payroll checks. And then there's this small entrepreneur, the person who, maybe took out that, that starter loan, so that they could begin building, in Web3, et cetera. What should they expect, on both sides of that spectrum?
Yeah, it's, I don't think anybody there is personally going to be somebody that's going to be within the zone of target, just to be clear. So I'll start there by saying that nobody there is going to get sued by the FDIC, because they're not looking for that. What the FDIC is looking for is for the people at Silicon Valley Bank that knew that there were capital control problems, that knew that there was a risk, et cetera. But for the people that, unfortunately, are more, there's a likelihood that they might mispay because the paychecks can't get deposited. If Rippling can't work things out with JP Morgan or whatever, they can't make the payments. If, in fact, the assets to make those payments because the actual company banked at the bank, at Silicon Valley Bank, that there's no money to pay with because it's all frozen right now, or the payroll is in excess of $250,000 and the operating account is only insured up to $250,000. So that's going to be tough, and I think that there's a serious likelihood that there will be some people that will be, and some companies that could be shut down as a result of this. I don't think that's out of the question at all. I mean, you take startups that are small, young companies, every dollar matters, and you're operating all the time looking for how far can you stretch, what's the burn rate. And for both then the workers and for the people who started the companies, that's going to be a problem. But I think there are some ways that those folks can have some hope, but in the near term, it's going to be pretty tough.
Pretty devastating news. Thank you, Nilay Vora, for bringing that devastating news to the forefront. But I think, that's the thing is like, in terms of, advocacy, like, what is it that they could be seeking, or what, moves should they be doing? Or at what point should they start seeking somebody who knows the ins and outs like yourself?
Yeah, I think that it's always important to figure things out. Look, I mean, there are some very sophisticated players in this market, and there are some very sophisticated depositors who were keeping things at Silicon Valley Bank. I mean, there's rumors right now and reports that go beyond mere rumor that some of the larger venture capital funds were aware of the problems, and that Silicon Valley Bank executives or some people who work there let them know ahead of time that they should start pulling their money out, and that probably might have caused a spook that ultimately led to the whole bank run. But the most important thing that I always say is the time to look for figuring out a solution here is before you sign anything. Don't sign anything until you talk to a lawyer. Because the problem that a lot of people don't understand is that, everybody thinks, okay, fine, like, I'll just sign this paper because who cares? The money's, the FDIC is going to do what they do, and I'm just going to have to do what I have to do, and there's no money to be had anymore.
What do you mean in terms of signing a paper? So somebody's going to present an offer for a settlement, you're saying?
Yeah, I think it's possible that there will be opportunities that people might try to offer settlements. People might try to figure out, and this comes from all sides, right? I mean, the worker has a different perspective than the company, for example. When the worker is paid late under California law, by way of example, the first time that there's a late payment, there's an automatic penalty of $150 by labor code. So $150 mandatory penalty. It doesn't matter if your bank failed. There's no excuse for your bank failed. The second payment that's late, you have an automatic penalty of $200 plus 20% of the amount of the wages that were supposed to be paid. So now we're talking, when you start getting into this, now we're starting to talk real big money, right? Because now you get 20% of the money.
It's also the days that you're late as well, right? If it's late, but if it's late, significant days after, that increases.
There can be penalties for late payments as well, and so usually those will apply only to the final paycheck, but sometimes those penalties can apply in other places as well. But these are the ways, like what you're talking about, all those things can add up, and so from the worker's perspective, there might be situations where your company says, okay, look, we're late, but, we're going to make it up to you. And if I were advising the company, I would just tell them, listen, it's just not worth it. Just pay the penalty. Hire a lawyer, calculate what the penalties are, and just do the right thing under the law, because it's just not worth it. On the flip side of it, if I were the company, the thing that I would be very wary of is that a lot of times, either you will get an offer of a settlement, and that will require you to release your claims. That you really want to have a lawyer look at, because you don't want to release something that you don't know what you're releasing. The second thing, though, that a lot of people have been asking me, and it's a very good question, is, hey, come on, aren't I covered? There's going to be some class action lawsuit here. And surely I'll be covered because I'm a member of the class action lawsuit, right? Everybody who had money at Silicon Valley Bank is, whatever the remedy is, I'll just tag along for the ride with the class action lawsuit. That's a very dangerous angle to play, because the class action lawsuit may not bring the kinds of claims that would apply to everybody in the class, and you may be uniquely situated. And I'll give you a quick hypothetical example. Imagine that you have a company and you've got 5 engineers, 6 engineers. Turns out that you can't pay 4 of the engineers because of the Silicon Valley Bank collapse. Let's say you have $250,000, and you're going to use all $250,000. Or sorry, let's say you had $500,000. $250,000 is gone because it's above the FDIC limit. That $250K, let's say you were going to hire 4 engineers with that, 5 engineers, argument's sake. 5 engineers at $50,000 for 6 months, argument's sake.
But they make much more than that. Trust me.
I'm aware. I'm just trying to give you rough numbers here. So we can cut it down to 2 engineers if you want to for a year, or for 6 months. But wherever we're at, the loss of those 2 engineers, that has ramifications, as any business owner knows. Every time you lose an employee, when I lose an employee, I'm very upset. So that ramification can cause big ripple effects for the rest of your business and how it operates, and it could even cause you to be delayed to market. Your competitors could get to market first. You could have to shut down an entire product that you were trying to put out. The class action lawsuits will not look into those individualized types of circumstances.
Sure.
And so that's where you want to make sure that if you're part of the class action, sometimes it might make more sense for you individually to opt out of the class, because you can pursue bigger claims than you would be able to as the class. And in other cases, maybe it actually is just the best thing to go with the class, because you have no real claims about products that you weren't able to push out, or payroll that you weren't able to make, or shutting down your entire company. But that's the kind of thing where you really want to make sure that you're careful. You never want to give up something for nothing, and you certainly only want to give up things that you understand what you're giving up. Too frequently, people give things up that they don't understand what the value of it is. It's no different than if I buy a Powerball ticket, lottery ticket, right? And the numbers haven't been drawn yet, and that thing blows away in the wind. You're damn right I'm going to chase that ticket down. I am going to chase that ticket down, because I don't know what the numbers that got drawn yet were, right? So
well, that's the thing. If you want to play the lottery, VoraLaw.com is apparently your ticket, and don't let it blow away in the wind. But it seems like it is going to be sort of a wait and see at the moment, because the full ramifications, as you said, have not been realized. They are happening right now. I'll go over during this episode what's happening in the market currently. We're not a huge market show, but right now it is absolutely devastating what's going on. Stable coins that are pegged to the dollar are down 10%. And we all sort of saw what happened with FTX on that last go round. So it's very, very scary to see that. But don't worry, there's a lot stronger players here. I think that there's far more people who are far more into the regulation and abiding by and complying with the regulations that allowed for actors like Silvergate to solve their own problems in a sense and not require the FDIC in that situation. And so there is some hope that this isn't going to be the bloodbath that it's seeming, but it can be a scary time, and certainly if you're involved and have certain questions that you need answered, this is why I have Web3 Media friends. Is I reach out to VoraLaw.com and say, hey man, what is the situation here, so that I can get a unique perspective and a different perspective as to my situation. So. Thank you so much, Nilay, for talking to us and getting our heads straight about the opportunities of and also giving us just the perspective of I think in a scary situation, really, truly, for all participants. And that's the weird part is due to this, it's just like everyone in the entire spectrum, from the creators, the founders, the entrepreneurs, down to the person getting paid, we're all in a pickle, and due to someone not complying to regulation. And so does last question, does the FDIC coming in, because they have to do that, I mean, is it a de facto thing that they have to sue, they have to find somebody at blame here and make them pay to some degree?
It's a good question. To the extent that there's a desire to, put a head on a pike or something, it is human nature to want to do that. This is real Game of Thrones stuff, right? I think, there's always a human desire to have some of that stuff happen. Bluntly, I think the answer is yes. I think that there will be some investigation there, that this is something that's going to lead to that. I think that this is also another place where, I think that workers who used to work at or still work at Silicon Valley Bank really need to know that, if you blew the whistle, if you tried to blow the whistle, if you had raised the red flag, or even if you were just caught up in the middle of this, you're going to probably get interviewed by government officials, and make sure you have your lawyer, make sure that you have the company pay for your lawyer. They're required to do that. It's just because you never know what you're going to end up being asked, and whenever the government's involved, I always tell people to be careful, because an accidental false statement, which may appear accidental to you, is something that the government is always looking for to have some leverage through a penal code section for the government, for the federal government, section 1001. If you make a false statement to a government official, it's a crime, and they'll try to sometimes use those kinds of ticky-tack crimes to try to twist people's arms into testifying a certain way, or otherwise just doing these kinds of process crimes. So I was just telling people, look, it applies to the FDIC. It doesn't have to be the FBI that's interviewing you. It applies to any government official. If you lie on your taxes, it's the same thing. So you just want to be really careful, making sure that you know what you're doing. But yeah, I think there's going to be some people who that the FDIC is going to look for to put their heads on spikes.
And that's the crazy part is even, I actually wrote a movie about this, about the previous experience I had of the fund, going belly up, because I was getting kind of hints and like little notes of just like, it wasn't straight out like, hey, this is happening, but like, when I would call and talk to the secretary or something like that, I could just tell like something was off, right? But after it all went down, I was like, fuck, they knew. And I was just in Denver and talking about, with a lot of, people who have experienced, crypto scams and been, had eyes in on companies that, had been doing this, and they were paying everybody insane amounts of money, like, down to like, the simplest worker, overpaying them for, to keep them quiet in a sense. And so I felt like that there's definitely something existing here that is going on when people are making way too much money than they should. Like, it's just like, it's suddenly like I'm making 3 times, what I did, like in the same job. But like, you got to think something's going on, right? And it's just like, as you said, the whistleblowers, and they're very limited, it seems, in terms of, the reason to do it, other than to be, you're going to be vilified, you're going to be screwed, you're going to get, the pressure of all that. Somebody like me might make a movie about you, like, in 10 years, but the entire decade you're effed, right? The entire
It's hard. I mean, it's a really hard thing, because especially you gotta, like you said, right? A lot of people get paid a lot of money to look the other way, and you're the one that destroyed everybody's living by bringing down something that should have been brought down. But I mean, I think that's something that everybody's got to keep in mind here, is that banks take risks, and the question is, what is the type of risk that they're taking? I mean, when you look at some of the products that Silicon Valley Bank was pushing, you walk into Citibank and you tell them, I've got 5 guys who graduated from Stanford and we want to start a company. Can you please loan me $5 million? Do you have any assets? No. Do you have any cash flow? No. I mean, this is a typical thing that actually what you should be doing is going out and raising capital from people who want equity in your company, or warrants, or debt for equity, or whatever the structure of that financing is. A traditional bank that accepts deposits should not be doing that kind of stuff. And that's what I talked about at the beginning of the show with, like, shadow banking. This is the kind of thing that also got us into some of the banking crisis back in that 2007, 2008, 2009 timeframe. Is that the banks were actually just doing a lot of speculative stuff, the deposits, and Dodd-Frank was supposed to solve much of that, but you can't stop.
Take me back. What is Dodd-Frank?
Sorry?
Take me back. What is Dodd-Frank? I don't know that.
Dodd-Frank was one of a number of package of bills that was passed back in the Great Recession, 2007, 2008, and the fallout therefrom. So it was one of the first. It was one of the major financial overhauls that the Obama administration signed into law, and that was passed by the first Congress when Obama was president. And it really forced banks to have a lot more capital requirements, to have cleaner balance sheets, things like that. And so it was designed to sort of, stop some of the speculative stuff. And then you had the stress tests, and the Federal Reserve had a role to play. The Office of Control of the Currency had a role to play. The FDIC had a role to play. There was all this stuff that happened, and frankly, I know a lot of people that are watching this are pretty skeptical of banks. Frankly, it worked quite well when it worked. And that sounds like a stupid thing for a lawyer to say. Well, of course it worked when it worked. But, the truth is, it really did work pretty well. Silicon Valley Bank, I know many people that bank there. In fact, I used to be paid by clients who banked at Silicon Valley Bank, and I think that the thing about that bank, though, is that sometimes it gets a little too friendly. And sometimes it's like what you said, Minty Fresh, about, you call the secretary and just sounds like kind of funny. And there's people that are just getting paid a little bit too much money for the kinds of work that they're doing. We're not here to disparage anybody or how they make money, but it just doesn't quite fit, the situation doesn't quite fit. That's the way that I always felt about Silicon Valley Bank, honestly. I don't understand how you can give somebody a $3 million mortgage when their company has no cash flow. All they have done is raise money through investors and lost money. They do not generate any cash flow. They just generate more investors. And that sounds like giving a mortgage to a Ponzi scheme leader. I wouldn't do it. I don't understand how a bank that takes other people's deposits does it, as opposed to being a venture capital investor or some other form of lender, but not a deposit bank. I think that's very unusual.
Silicon Valley venture capitalist should be on the banner, not bank. Thank you so much again for making these delineations for us, and always such a pleasure talking to you. Hopefully have you back again sometime, Nilay.
Love to, Minty Fresh. Had a lot of fun. Thank you very much for having me on, and thanks to your audience for watching.
Talk soon.
Oh yeah, that's the stuff. That's what I'm talking about, guys. What are you doing? What are you doing? I was just really enjoying this 30-minute chat with a lawyer. It was so talking about banking and regulations. Oh, the pain. Okay, well, please stop doing that. And some people are indeed in pain, and we're here just to make light of the idiocy that is this space. I mean, look, you yourself, my bags are very heavy into an S&M ape that pleasures himself with the pain of others. And so the absurdity of it all is why we're here, and I thank you for watching.